I think that tax planning can move the needle more than anything else in retirement planning. And I also think that I consistently see people making three big tax mistakes when it comes to planning taxes in the retirement. So in today's video, I'm gonna walk you through those three different mistakes, and I'm gonna make sure that you have the information to potentially save you 10, if not hundreds of thousands of dollars in taxes over the rest of your life if we can just avoid these three big mistakes. My name's Kendall Stahl. I'm an advisor and partner here at 210 Financial, and we're doing the best that we can to educate the American retiree just like you on all things retirement planning. So the first mistake that I see people making is not understanding capital gains taxes, all right? And how can they utilize that in their retirement plan? So let's work through a scenario. It's a made up scenario, but a scenario that we see consistently in our firm. And so let's pretend it's a married couple and they're 65 years old, all right? Let's also say that they need $10,000 to $11,000 a month in retirement income, all right? And let's say that if we can find a way to get that $10,000 to $11,000 tax-free in retirement, that would obviously even be better. Okay, so we've got an IRA, we've got a Roth IRA, and then we've got a brokerage account, maybe just a joint account with some stock inside of there that has some gains. So long-term capital gains tax rate. If you're married filing jointly, what this is showing you right here is there's different brackets, all right? And so you can have up to $98,900 if you're married filing jointly in income before you have to pay any capital gains tax. All right, so what does that mean and how can we apply it? So let's think through this. All right, so we're drawing these three tax buckets. We're gonna draw our tax deferred bucket. We're gonna draw our taxable bucket, and then we're gonna draw our tax-free bucket, all right? In this scenario, we're 65 years old, and we've got, I don't know, let's say we've got 500,000 in our IRA, and we have another, I don't know, $1 million in our taxable account, and say we've got 200 grand in our tax-free account. Well, what we need to know is that this taxable bucket, all right, maybe it started a long time ago with $500,000 and it's grown to $1 million. So you have gain inside of that account. All right. Well, we also just realized that, hey, we don't have to pay taxes on that capital gain until we start to surpass that $98,000 mark. I'm going to go ahead and say we're going to take a $47,500 distribution from their IRA. Basically, what we're doing here is we're taking $47,500 out of that bucket and we're thinking, oh, that's our IRA. We're probably going to have to pay tax, but not so fast because we all have this thing called a standard deduction. All right. Since they're 65 years old and it's the year 2026, we also have an extra standard deduction because of their age. So if we scroll down here to the bottom of the page, we're going to see their standard deduction is $35,500, and they've got an additional deduction of $12,000. Therefore, you add that together, that's a deduction of $47,500. What's going to happen there is that's going to completely wipe out that $47,500 of income that we took from the IRA. Hey, today's video is about taxes. There's some detail. There's some key takeaways. And so we're going to summarize those key takeaways, and I'm going to put them in the description down below so that you have something tangible to take away from this video. So we just took $47,500 out of the IRA, and we don't have to pay any taxes on it yet. Okay. But we're trying to get to $10,000 to $11,000 a month. So how can we do that and not have to pay taxes? Well, let's think through what buckets we have. We've also got money in this taxable bucket, which is taxed at long-term capital gains tax rates. But if you remember what I said a few minutes ago is, we can go all the way up to $98,900 if you're married before we have to pay capital gains tax. So can we take advantage of that? The answer is absolutely. I'm gonna show $85,000 in long-term capital gains tax here, or I'm sorry, long-term capital gains, okay? So what's that look like? We've got $47,500 coming out of an IRA. We've got $85,000 coming out of that taxable account, that joint account. We're gonna have to pay long-term capital gains tax rates on. Total income, $132,500. Hey, that's whatever, a little over $11,000 a month in income that we got them. We've now got that standard deduction that offset that IRA income. Our taxable income's only $85,000. Hey, we stayed below that $98,900 mark. So what does that mean? Our total tax is zero. So if we bump out to our tax report and look at it, what does that look like? Well, in this situation, it looks like we've got $132,500 worth of income, but we're gonna have to pay zero in taxes. All right, now, a couple things to know. One, I'm only talking federal tax, all right? So there could be state tax depending on what state you live in, all right? And so we need to understand that there could potentially be some state tax. But the point that I'm trying to make is we need to understand what type of dollars you have where and how those tax brackets work, and can we get that money out without having to pay taxes? In this scenario, we absolutely can. Now, there's other scenarios where it might be harder to do. For instance, let's say you are 65 and you have already turned on Social Security. Now, I think this is rolling right into mistake number 2. When it comes to mistake number 2, I'm not gonna go into great detail onto this, but I wanna give you enough information to just kind of educate you, get you thinking through it, and then making sure that you're kind of checking those boxes off as we go. All right, so Social Security is not taxed if you don't have any other income. There's a little bracket that says, okay, if you don't make X amount of dollars, Social Security is not taxed, but if you make more money, we can start to tax Social Security. All right, so if your provisional income is under $32,000, 0% of your Social Security is taxed. Provisional income is other income, all right? So it also includes half of your Social Security. As soon as you bump over $32,000, between $32,000 and $44,000, half of your Social Security can be used to calculate towards your taxable income. And as soon as you're over $44,000, 85% of your Social Security is gonna be taxed. They're never gonna tax more than 85% of your Social Security. Don't hear that wrong. If you have $10,000 of Social Security, they're only gonna use $8,500 of it to calculate towards your taxable income. So as we jump into this scenario, 65-year-old clients, married filing jointly, obviously this could be a little bit different for everybody depending on your age and whether you're filing single or joint taxes. So you need to talk to your CPA or your financial advisor about your specific numbers. But the first thing I want to just show you is that, hey, the first scenario, I guess, is we're going to take $7,000 out of an IRA, but combined, we're also going to have $50,000 worth of Social Security. Now you'll see this line right below here. Whoops. You'll see this line right below here. It says taxable Social Security, and it's a 0. And that's because your provisional income is not greater than that $32,000 number that we talked about. All right. And so you're able to take your Social Security, little bit of money from your IRA or income from elsewhere, and your Social Security isn't taxed. But in scenario number 2, hey, instead of $7,000, we're going to take $50,000 out of the IRA, which is taxable. We're going to have $50,000 worth of Social Security. Now your provisional income has exceeded those limits, and $32,000 worth of your Social Security is getting calculated into your taxable income. And so here's what I think people miss is that, yes, you maybe are in a 12% bracket in this situation, but with that 12% bracket, the next dollar you take out, you may think you're only going to pay 12 cents on that dollar. but depending on where you're at in that 12% bracket, it could actually cost you quite a bit more than that, because that next dollar bumped you into having your Social Security be taxed, or it bumped you into the next level or more of your Social Security being taxed. So that mistake that I think people make is not understanding how Social Security is taxed and bumping them into higher rates of your Social Security being taxed when maybe you didn't mean to, maybe you didn't know that was even a thing, or hey, it wasn't necessary. Maybe somebody said, hey, we need to do a Roth conversion, made your Social Security taxed at a higher rate, and then kind of negated the reason behind the Roth conversion, potentially just one thought process or one scenario. Mistake number 3 that I think a lot of people make actually just rolls right into what we were just talking about, Roth conversions, all right? Sometimes I think people are so scared of what their required minimum distribution could be in the future that they convert too much money right now and pay more taxes, or maybe pay excess taxes on their Social Security. Whereas if we can just start thinking about lifetime taxes and smoothing the taxation out over your lifetime, and maybe we're gonna be okay with some required minimum distributions in the future, do some Roth conversions today to work those RMDs in the future down, but still have them and stay in kind of a nice level tax environment. So not understanding how a Roth conversion can affect you over your lifetime, I think, is that third mistake people make. Let's think about lifetime taxes when it comes to Roth conversions instead of just last year's taxes when it comes to Roth conversions. All right, so those are the 3 different mistakes that I think folks can make when it comes to tax planning in retirement. And since we're talking about Roth conversions, here's a video right here on several different reasons why not to do a Roth conversion. We'll see you next time.